CPI and PPI was the big story this week. And, of course, CPI focuses consumer price index, and PPI is producer price index. And we had a producer price report that came out late this week, and it was heavier than what we expected it to be. We thought at some point, Brian, that perhaps the deflationary environment that is in China would be imported to some extent, and we really haven't seen that.
That is one of the interesting dynamics here is for many, many years, we were importing deflation, so lower prices from China, and they were the factory to the world. But now we actually are seeing some of those producer prices tick up a little bit. Now, thankfully, I do have to point out that on a year-over-year basis, the producer price index increased only 0.8%, but that's kind of headed the wrong way. China has been struggling with deflation, so an outright decline in prices. We thought we might get some of that, but honestly, we've been seeing a lot of this more near-shoring and close-shoring, friend-shoring is what people call it sometimes, and so a lot of trade, it's actually moving through to Mexico and to Canada instead of directly from China. So maybe that's part of the dynamic.
I think you're going to think this is funny. I read the report, and you're the guy with the PhD in economics, but I read that report, and I found some funny things, and funny not ha-ha, but one of them was the service costs were up, and there was a lot of that went into that. But here in the United States, we did talk about rental equivalency, folks, which is the real estate going up, and of course some other things still remain strong, which would be like wage inflation. But service cost was up. Did you notice that?
Yeah. So that was both in the consumer prices and the producer prices is the strength in service prices. So what we've seen since, maybe about a year and a half ago was goods prices declining, but yet service prices rising. That's what the Fed has been really worried about, is whether or not stronger wage growth is going to lead to stronger consumer price growth, which then makes their job that much harder. I think, honestly, we're going to get a reprieve in that because I don't think wages are growing at an unsustainably fast rate. So hopefully some of this is, I don't want to have to use the word, but maybe transitory.
No, that's the word that we didn't like, of course, used by the Federal Reserve, and they were unfortunately very wrong on that. But here's the other thing. You talked about the Fed's difficult job, and one of them, of course, is commodity prices continue to go up, and we watched the price of crude oil continue to tick up this week.
Yeah, the price of crude oil has been going up, and so we've had a number of reports come out. So there's reports from like the Energy Information Agency in the United States. There's also the International Energy Agency, which is more international. And both of them are giving forecasts suggesting that demand for oil is continuing to rise faster than what they thought, mainly because people are driving again.
Right.
And yet the supply picture is still a little contained. The U.S., the producers aren't ramping up production as much, and that's just because of years upon years of regulation and underinvestment. It's one of the reasons why when we talk on the investment committee, we've been overweight energy, is just we think that the longer-term dynamics favor higher prices, and we believe that could then result in better cash flows to investors.
And not only that, not only here in the United States are we seeing more demand, but Europe has come back online, and we do expect China at some point to straighten out their house as well. And that's the reason why when we talk about overweights and underweights in people's portfolios, Danny, we're talking about where we should move the chips around, and that's what we do on a daily basis. When you hire a firm like ours, we do this on a daily basis. We go into your account and we make those proactive moves.